Okay, so let's start there on problem number 2. Here we have an electronics manufacturer, and the production manager is this guy, Florentino. And he gets compensated based on the profits of his department. He gets to choose if they're going to make between 2 different products, an industrial motherboard, which, as it says, has a 75% probability of a $1 million profit, or a 25% probability of a $150,000 profit. So that's a pretty big differential, right? Probably make $1 million. It might only make 150,000. Or if he chooses a regular motherboard, they feel that they're definitely going to make a profit of 710,000. As it says here, Florentino gets a 20% bonus based on the profitability of his department. And he is a risk taker, more so than top management at his company. So being a risk taker, do you think he's going to go with the industrial motherboard or the regular motherboard? I think he will go with the industrial because he's going to hope for this $1 million profit, of which he gets 20%. And which product do you think the company executives would prefer? They'd probably go the safer route, right? And it says that they're not as much risk takers as Florentino, so they would probably go with the regular motherboard. Now, the real question here, what changes should the company make to Florentino's compensation to avoid unnecessary risks? Right, because right now, he's got an incentive to shoot for the $1 million profit, right? But there's a chance the company might only get 150,000, which he would find very disappointing, and so would the company. So what could you change so that he won't be so incentivized to go after those risky situations?
Lower his bonus.
Okay. You could lower the percentage of his bonus. Which he probably wouldn't like too much, right? Mm-hmm. What else could be done?
A higher salary.
Okay, increase his salary. Because then he's making more money and he doesn't feel so, tempted to make these big risks. Another thing you could do is say, yes, you get this 20% bonus, but only if our profits meet a certain threshold. We have to make at least a $500,000 profit. Otherwise, you don't get the 20% bonus. If that were the case, maybe he would go the safer route, right? Because then he risks getting nothing if they have a smaller profit. And then profits. Any other thoughts? So again, 3, I think you can handle, and let's go to number 4. Now this I've agonized over this problem many hours, but I think I've got it down now. And in fact, to simplify it, in my lecture slides here, let's just make it bigger. I've color coded it. So the question here is residual income, and you might remember residual income. Basically, it's what is your profit minus your investment times the cost of capital. In this chapter, they call it, instead of cost of capital, they call it minimum required rate of return. So it might be a little bit different than how you learned residual income, but it's basically still the same thing. So in other words, of the profit that we earned, what's left over? What is our residual income? So you would take the annual profit and then you would subtract from it what was the cost to acquire that profit, not the investment itself, but just the cost of capital for that investment. Okay, so for example, your investment was $1 million and your cost of capital was 10%. You take $1 million times 10%, that comes out to 100,000. Subtract that from your profits, and that would be your residual income. So that would be just a basic example. This one is a little more complicated. So let's walk through it. It's a hospital, and they give us the after-tax income for the hospital. Well, that's the first problem, because there is a formula that uses after-tax income. We went over EVA? Did we do that last week? Economic value added? Maybe that's in this chapter. It doesn't come up on any of the problems, I don't believe. But let's see. Yeah, EVA is in this chapter. So EVA does use after-tax income, but all the other formulas that we've used that are based on income are before tax. So that's one problem, is we're going to have to convert this to before tax income. They tell us what the tax rate is. Good, we'll need that. They tell us the total assets of the company, but we don't need the total assets. We just need the capital assets, right? We don't need to know their short-term assets. And then they tell us the current liabilities. Well, what we're supposed to figure out here is that current liabilities are used to pay for current assets. So the current liabilities would be equal to the current assets. And if we subtract that from the total assets, that'll give us the capital assets. Okay, so we're supposed to figure that out. They do give us the 18% minimum required rate of return, and then they want us to calculate residual income. So again, I spent a lot of time just trying to figure out what they were going for here. I think I've got it down. So the first thing we need to do for our, here's our formula down here. The residual income is the profit from this project, so the income, minus the investment, they're calling it project invested capital, times the minimum required rate of return, which was 18%. So the project profit is $7 million after tax. We have to convert that into pre-tax. That's our first challenge. So how do you take an after-tax amount and convert it to pre-tax? Anybody know? Okay, our tax rate is 30%, right? So that means whatever profit we earn, 30% has to be paid out in taxes, income tax. And that means we get to keep 70%, right? If we're paying a 30% tax, we're keeping 70%. So what we do is we take our after-tax profit, divide it by 70%, and it tells us what our pre-tax amount was. We take our $7 million after-tax profit, divide it by the portion that's 70%, right? 7 million is 70% of what we earn, because that's the part we get to keep after taxes. So our after-tax profit divided by the 70%, and that tells us what our pre-tax profit was, $10 million. So great, now we know the first part of our formula. Next, we need our project invested capital. So again, that's our capital assets. And again, we can assume here, if our total assets were 70 million and we had current liabilities that allowed us to pay for $22.8 million of current assets, you can subtract those current assets from the total assets, and that gives us $47,200,000 of capital assets, which we then multiply by our 18% minimum required rate of return. That multiplication comes out to this 8.5 million. Subtract that from our pre-tax profit. There's our answer, our residual income of 1,504,000. So that's the answer. Okay. If they had presented the information to us a little more clearly, wouldn't have been so hard to calculate, but I think they were just trying to give us a challenge. So any questions on this problem? Okay. Then let's go on to the next one, number 5. Yes, okay. Oh, okay, this one does use EVA, but we don't have to do any calculation. So again, economic value added is a similar calculation. It's just that it's based on after-tax profits. You see EVA, which stands for economic value added, is after-tax profits minus the invested capital times the weighted average cost of capital. So it's pretty much the same as residual income, except that you're starting with after-tax income. And the reason we have multiple metrics that we can use here, we have ROI, EVA, residual income, is they each give us a slightly different perspective of what's going on. So by using a combination, and then you're trying to analyze multiple different options, it just gives you a fuller perspective. Might help you see some things you didn't see otherwise. So let's go ahead and apply this. So this is a bookstore. It says it's a traditional bookstore. It's been there 40 years. And they started an online book division. The EVA for the store is $13 million. Okay, so that's what's left over after taxes and after you take out cost of capital. However, the online division has a negative EVA of 2.2 million. You want your EVA to be positive, just like you would with residual income. If it's negative, that's not good. First question here says, explain why it would be better to evaluate the online division using a balanced scorecard. Obviously, if we only looked at the financials, we would say we're losing money here. This isn't working, right? What would be the advantage to using the balanced scorecard to evaluate the online division? Remember, that would mean looking at the customer perspective, learning and growth, internal operations. Everything.
Internal operations?
Yep, we'd be looking at all of that, right? We applied the balanced scorecard to evaluate the online division. We would look at all 4 perspectives. It would give us a more holistic view, right? So I can say the balanced scorecard. Gosh, slow down. Would provide a more holistic view of the online division performance. Okay. B says, suggest 2 measures for the customer dimension that would be appropriate for the online division. Customer dimension. And 2 measures for the internal processes, which is also internal operations. They're just changing the terminology a little bit, but it's the same thing. That would be appropriate. So let's think about it. In evaluating this online division that they've created for the bookstore, what would be some ways we could measure the customer dimension? How could we determine if the online division is doing a good job in terms of the customer dimension?
Like online reviews of the bookstore?
Okay, reviews. That'd be a great way. Yeah. What else?
Much traffic sitting.
Okay, traffic. So web traffic for the online division. Could use surveys. Those are pretty common, right? All of these would give us some insights. We could also track, for example, how many customers referred other customers or came back and made multiple purchases. Okay. So there are quite a few different ways we could measure customer perspective. How about our internal processes for the online division of the bookstore? How could we measure performance, the internal operations?
The amount of sales they have.
Well, that would be more financial, right? I mean, that does relate to the internal operations, because obviously if people are ordering books and we're not processing those orders, that would be a problem. Or if we're not sending out the books, that would be a problem, right? So there is a relationship there, but think more about what's happening kind of behind the scenes. How could we measure that? I'll give you a couple ideas. So for example, order accuracy. Are we delivering the books that our customers are ordering? Because if not, obviously they have to send it back. We have to give them a refund, right? That's a problem. How about the processing time, right? Order comes in, we ship it out the same day. That would be a pretty good turnaround. Think of 1 or 2 others related to internal operations. What could we measure? About the number of different books we have available. I'm thinking about it because let me think. Would that go under learning and growth? That might be more learning and growth. So sometimes it's kind of a gray area in between. Let's just say inventory management. If we were talking about inventory costs, then that gets more into financial, but inventory management, more general term. So for example, are we getting the inventory in on time?
From the supplier.
Yeah. Yeah, are we able to get the inventory we need from our different suppliers? That sort of thing has more to do with our internal operations than with the financials. Okay, so I think you get the idea, right? There are quite a few different things you could measure in these different areas. And some of these might carry over. For example, if, let's say a customer walks into the store, they're looking for a certain book, we don't have it in stock, but we say, hey, you can order it from our online division. Okay, so now it's benefiting that, in-person customer. So even though we're losing money on this online division, overall, it might benefit the company as a whole. So that's why it's helpful to take a broader look and see if it makes sense to keep it, fix it, maybe if there's something you can do to make it more profitable, or maybe get rid of it. I don't know. So I think that's it for problem number 5. Yeah, it looks like we covered everything there. So we can go on to our last problem. So this is a company that designs, best I could tell, it's some sort of clothing. And it says their strategic plans call for rapid growth, a limited number of units for each design to enhance exclusivity. So in other words, when they come out with a new design, they limit how much they produce to make it more exclusive so they could charge a higher price. A lot of luxury brands do this. Designs for the perfect fit. So that's something that's important to their strategy, that their clothing fits perfectly. On-time delivery is important to them. Retention of their employees. And excellent inventory control. So that's all part of their strategic plans. The first thing we have to do, here we have the 4 elements of the balanced scorecard. We need to think of at least one metric for each of these that will help this company achieve its strategies. So what would be one thing we could measure in terms of their financial performance?
It'd be rapid growth.
Okay, so how would we measure rapid growth from a financial perspective?
How fast they can sell their.
Okay, yeah, so we could track their revenue growth, right? Or profits. If either of those are growing, that's a good indication that the organization is growing. How about internal operations? What is something we could measure regarding internal operations that would support their strategies?
On-time delivery.
Okay. Exactly. What about customer service? Product returns, right? Because they said the perfect fit is important to them. So if customers are returning the product saying, hey, it didn't fit, obviously we're not meeting that strategic objective, and it is a customer service issue.
Would it be like a quality issue?
Mm-hmm. Mm-hmm. So that would relate to internal operations as well. So that's one that kind of is in that gray area where it relates to both. How about learning and growth? What is a measurement for that? About number of new designs? Does that work? Okay, so we have one metric that we've identified for each of these 4 elements. Then we need to take one of these metrics and link it to all of the strategic objectives. So let's just pick one of these 4 that we came up with. I'll let you all pick. Should we do on-time delivery, product returns, or number of new designs? On-time delivery. Okay. Like that. executive decision. Let's just do that. So, so now we're going to look at these 6 strategic objectives down here and think, how does on-time delivery relate to each of these? Because there's really overlap between all the elements of the balanced scorecard, all the company's strategic objectives, all the metrics. They really all interrelate to one another. So how does on-time delivery help us with rapid growth?
Sure that if other customers write reviews about how quickly they got their product, and
Okay.
they read the reviews, then other people will incentivize to purchase.
Okay, so it would lead to good reviews and more sales. Okay. Would also help to minimize customer service calls. People are getting their products delivered quickly. All right, because if we're flooded all the time with people saying, hey, where's my product? Where's my product? How are we going to grow rapidly? How about enhanced exclusivity? Is there a relationship between delivering on time and enhanced exclusivity? I think there is. I think these days, if there's a new fashion out, it used to be that fashions changed, I think it was every year, and then maybe it was like twice a year, and then 4 times a year. And then Zara comes along and they're like, no, we're putting out new fashions every month. And they call it fast fashion. So that's the expectation these days. You come out with a new design, people want it now. So I think that that would be important. If the whole thing is creating these exclusive designs, somebody doesn't want to wait a week to get it because then somebody else already wore it, right? At some other party, and now it looks like they're just copying that person. So I think that on-time delivery would allow the customer to feel like they have the greatest, latest thing, right?
Fast fashion.
Fast fashion. Fast fashion results for customers. Okay, so the goal related to designs designs for the perfect fit. Does on-time delivery relate to designing for the perfect fit?
The quicker you get the product, the quicker you can try it on at home.
Exactly. And ensure that it is the perfect fit. And if not, you might still have time to get it, replaced. All right. So allows product to be tried on quickly. Did you know they have smart mirrors where it can show you what something would look like without you having to put it on? Mirror just kind of like superimposes it onto your reflection.
Well, they have that like filters on their phone.
Yeah, that's true. That's true.
It's not a whole lot different.
Yeah, exactly.
They also have like the furniture apps
Oh, yeah.
to see how it looks like in your room.
Yeah, exactly. Yeah, that's right. Okay, on-time delivery, obviously it's the same thing, right? So that is exactly, okay, so I'll just put the same thing. Retention of employees. Does on-time delivery help with retention of employees? I think happy customers makes happy employees, right? Because more hours like they're working harder to make sure the designs are getting out. Okay, that's a good point. I didn't think about that. So more hours for employees to work to get the designs out. And the other thing is fewer complaints from customers, right? That also helps with employee retention. I don't know how many of you have ever worked in customer service, but it can be a little draining sometimes to just take complaint calls all day long, especially when the companies have really messed something up. I remember when I was in charge of a technical support department for a small software company, and God bless you, we messed up something with our software, and our customers' websites weren't working, and they were relying on those websites for sales. And it took about 2 weeks for our tech people to fix it, and people were not happy. That was, and all I could do was just apologize. And there was not a single thing I could do about it. Last one. It's the last one, inventory control. How does on-time delivery relate to inventory control? Remember that term, just-in-time inventory management, right? Get it in, ship it out. You don't have to stock a whole lot of product. That saves companies money if they can do that efficiently. So I'd say there's definitely a relationship there. Okay, so we could have taken any metric that we came up with and related it to pretty much every strategic objective. So that is it. Any questions here before we wrap up? Okay. Well, again, if you want to stop, I'm sorry, I'm trying to